Welcome. This is the Freightonomics podcast. And I know what you're probably thinking. We usually have two people here. We have the econ guy, we have the freight guy, right? Where is the freight guy? Zach. Well, don't worry, Zach is fine. He's okay. He's doing well. He's out in Colorado skiing. So today you're going to have me. It's macro edition, the macro edition of Freightonomics. And today we have a full show. We are going to be taking a little bit of a departure from our typical Freightonomics series that we had going on, where we're going over the different components, slowly building up to introductions to the freight industry. But now we're doing something a little bit different, right? So we're going to do, I'm off the reins here. I'm off the rails, so to speak. It's econ time. And so what we're going to do is go over a slowing economy, right? So it's no secret by now, everyone understands that 2019 was a slower year. And that was for the general macroeconomy, but also for the freight industry. And the freight industry is a lot different from the overall economy. And we all know this. And so the thing that we're going to focus on today is how to navigate in these slower economies, how to really be profitable, how to optimize your gains in slower freight economies, and really how to prosper and how to really be able to accelerate when the time is right and how to make moves and how to pivot correctly. And so, quick backdrop. So before we bring in our first guest, because we're going to have a panel of guests today. And so, quick backdrop. Overall macroeconomy throughout 2018 was robust, with especially a lot of manufacturing production going online. We saw a lot of consumer activity. 2019, vastly different. A lot less manufacturing. Consumers are still strong, but not as strong as in 2018. And so there are a lot of components that really kind of factor into all that. And first, my first guest, Luke Falasca. You've probably seen him on FreightWaves Now with Sonar.
Hello.
Luke, an honor to have you here today.
Thank you for that wonderful introduction.
A man of many talents, right?
Well, I'm still trying to find one, but
you have a lot to choose from. So, Luke, you are a very versatile member here at FreightWaves. As I mentioned, you present often on FreightWaves Now. You are a broker in your former life?
Yes.
And you also have, is it With Sonar?
With Sonar.
With Sonar host.
That's right. Which is coming on live tonight at 7 p.m. So
7 p.m. Tune in, FreightWaves TV.
That's right.
So yeah, give us a little bit of a background about yourself and...
Absolutely.
Yeah.
So first off, glad to be here. This is my first time in the booth, actually.
Well, welcome.
Thank you. It feels great. A lot of power, I feel like, happens here. So I'll try to live up to the expectations. No, I came from the brokerage world before I was here at FreightWaves, and mainly I'm domestic truckload over the road freight between U.S. and did it mainly just here in the U.S. and Canada is what I did. A lot of long haul freight. About 90% of everything I moved was spot freight, which is a little bit different. Typically, you figure about 75 to 80% of the trucking economy is contracted, and then the other 25% is spot freight.
Yeah.
So I was heavy on the spot freight. But anyway, that's what I did. Built up a good book of business. It was fun. And then FreightWaves came along, just decided I'd rather be on this side of the freight industry.
Yeah.
I love it. I love the data side of things. And now I'm selling Sonar to folks and running a show, which is just mind-boggling.
A lot, right? A lot. Yeah, no one would have thought. Like a year ago, maybe 5 months ago, it's just a lot has happened over the last few months. And FreightWaves is just a lot in general in this building. But as you mentioned, so you're selling Sonar, you're involved, you're also analyzing a lot of the trends.
Yeah.
And so you get to see a lot of both aspects of the analysis and then also in the trenches from clients that are really living this, right?
Mm-hmm. Absolutely, yeah. So there's, coming from the brokerage world, you're able to kind of play both sides of it. So obviously you're in the brokerage space, but you worked a lot with carriers as well as shippers. So you almost you really see every piece of the puzzle, or at least from the domestic truckload side. And then talking to those customers. Really with Sonar, there's so many different things you can do. But ultimately, it just comes down to everybody's using it just kind of based on how the freight economy is trending, right?
Yeah.
I mean, there's, so, I mean, it's no surprise that freight rates are down right now. So folks are trying to find ways that they can find areas of growth, areas where rates are increasing, or areas where there's more volume or market share that they can potentially grab or buy. So, I mean, you talk to folks like that, you try to figure out what areas they're struggling with, what areas they're succeeding in, and you just pick up the pieces along the way and find areas for them to succeed.
Yeah, and so one of the things you mentioned is the freight economy.
Yeah.
Could you give us a broad overview of what is the current condition of the freight economy?
Yeah. So I think as a whole, I think sentiment is actually a lot lower than probably the freight economy actually is.
Yeah.
So what's interesting is, and I was actually looking at this as of this morning, so it's a really good question. We were looking at the year-over-year changes for freight volume levels, right?
Mm-hmm.
So essentially just what is the overall volume in freight, broken up between dry van and reefer. Those are the two most common modes of transportation. Between those two, I think they move close to 85% of all over-the-road truckload freight. So interestingly, you saw a lot of truckload carriers go out of business last year. It was close to 900, which is a lot.
Right.
So far this year, there's actually more volume. There's a 2% increase in dry van volume from this time last year and an 8% increase in reefer volume from this time last year. So it's a little odd. But rates, on the other hand, are significantly suppressed.
I got you.
So you're kind of in this odd space right now where there's a lot of loads to go around, more than there actually have been in the past.
Yeah.
But they're not paying that well. So it may have to do with a lot of capacity hitting the market, a lot of things. But folks are having to deal with this, both carriers and brokers.
Yeah. So, and that was one of the things we expected, right? Going into 2020, we expected a slower start.
Yeah.
I put a piece, shameless plug. I wrote an economic piece at the end of December, slow start, strong finish.
Yeah.
And so we saw some slower activity at the end of 2019 going into 2020. So we expected a little bit of a slower start. And as you mentioned, rates are still suppressed, but we're starting to see some climbs in volumes.
Yeah.
But there is, I think, a lot building up, some catalyst, so to speak, in the second half of the year.
No, I agree. So there's a couple of things there. Hard to pinpoint the silver bullet, but one interesting caveat is truck orders are not quite being purchased at the replacement rate. So that would indicate that there is a potential for capacity, a paradigm shift in capacity, to where capacity may start to tighten, which in theory would drive rates up.
Yeah.
Which would be a good sign for well, I guess everybody but shippers.
Yeah.
They obviously like to push those down. So, yeah, I mean, there's a couple of things there. Obviously, you have a lot of truck exits last year that could also help tighten capacity a little bit, which is very unfortunate. You don't want that to be the case. You know, there's a lot of jobs lost there. But, I think you'll see a lot of those things come into play.
Yeah.
Especially as the market continues to shift. And we'll see what happens with volume levels, too. If volume levels continue to rise and capacity kind of goes in the other direction, you may start to see some upward pressure. Kind of like you said, second half of this year. It takes a minute for things to evolve in trucking. It's not an overnight shift.
Yeah.
Volume levels have to be higher than capacity for a while for, I think, everyone to catch on. Got
you. And so I think soon we're going to have Donnie Gilbert, the legendary, the lovely, what was the other adjective? What is that other one?
There's so many.
The delightful. Donnie Gilbert is going to be joining us soon. He has a lot of experience and in the trenches as a broker as well, operating during some of these down times. But so what are some of the, I guess, points that you're able to really kind of help with your clients on being able to pinpoint and opportunities during these downward times?
I'd say a perfect opportunity is this. Listen, you can't change the fact that rates are down. Rates are down. Sure, there are some areas where there are better opportunities relative to the rest of the market, but the reality is rates are down. So you have, and with brokers, carriers got suppressed all of 2019, and essentially they've been suppressed for so long, they're pushing back on brokers. So brokers are being pushed down from shippers and up from carriers, squeezing their margins, which we're seeing. Right? I mean, C.H. Robinson is a perfect case. Their margins were actually lower this year. Or last quarter. So that's happening across the board. What you can do, though, is since volume levels are actually a little bit higher, but rates are continuously being suppressed, we'll see if they find a bottom here. It looks like they might be, but only time will tell us. It's a great opportunity to buy market share.
Gotcha.
And that's what we're telling folks to do. Buy market share now. There's more volume out there. Yes, rates are down, but eventually the pendulum will swing. It's a cyclical market or industry like we know. And you'll have that volume and the rates will catch back up and you'll be able to profit from that. So that's what we're telling folks to do now.
Gotcha. Yeah, and I mean, that's a huge part, right? Is capturing market share, because when we're seeing that people are operating in these downward times, it's like, when is the right time to move? And a lot of times, when we saw in 2019, people were moving at the wrong time, and so in 2018, everyone was just growing so robust, and then they started ramping up, and so they thought that ramp up was going to go into 2019, but it was already too late. So just as you mentioned, now is the time to be capturing market share. Now is the time to really start expanding, so when activity does pick up, you're well positioned.
Absolutely, 100%. I couldn't have said it any better myself.
Excellent.
That's why you're the head economist, and I'm just the dummy on the other side.
No, I just do econ from time to time, and you're the man of many talents. But okay, so I think we're gonna have Donnie Gilbert joining us here. I get a.
Am I getting kicked out?
I know you're not getting kicked out, but I think Donnie Gilbert is with us here somewhere soon.
Donnie, are you watching the live stream? Where are you? He's too busy being successful, is what it is.
Well, I know, but he's the lovely Donnie Gilbert.
He's here. He's coming.
All right.
Come on in.
Get in here, Donnie. Oh, my goodness.
Morning, gentlemen.
Donnie
Afternoon.
Gilbert.
Come on. You can't hear him. There's nice music playing.
You're welcome. Oh, no, you're here.
I'm here. Are we live?
We're live.
We are live.
We're live. And Donnie, one of the things that I was mentioning was that you are a man that is known by many things. The lovely Donnie Gilbert, the delightful Donnie Gilbert.
That's all you. You did all this to me.
But what Luke and I were talking about here is the comparison of how to operate, or I should say how to operate in different markets in the freight economy. And so you've seen up times, you've seen down times on the broker side of things.
Yes.
And so I'm curious to just kind of get your feedback on how should a broker operate? How should a brokerage operate during a downtime right now?
You better get on the phone.
All right.
That's for sure. So
on the phone.
It all depends on, during the market conditions, do you need the truck or does the truck need you?
Yeah.
And right now, a broker operates both as a shipper when they're selling the load to a truck, and of course like a carrier when they're trying to get the loads from the shippers. So right now, acting as a carrier, they need to get those loads from the shippers. And the shippers, since there's an abundance of capacity, they're letting trucks call in, because when those trucks are calling in, it's a lot easier to push those rates down. So number one, you have to know the market conditions of where you're picking up and where you're going, because you got to price this right. Margins are very narrow and they're very tight. There's no room for error. And it's basically a learn by mistake type market. So they need to acquire the freight, and that's the very first thing. And that's where you have to get on the phone every morning, first thing, with your current shippers. And be begging them for freight and be checking with them throughout the day. Plus, you need to be exploring the other markets. You have to get out of your comfort zone and operate in markets that you've never explored before. And again, that might be learned by mistake again. So, I did this many different cycles during the last 15 years. And one thing that's different now versus the past 15 years is our product like Sonar. It's been a guessing game as to what directions rates are going, how the markets are doing in different markets. And now you can actually look and see which direction rates are going in the markets, which can actually make it a little bit easier, but it's still difficult. But at least I know which direction the markets are going.
Gotcha. And one of the things you mentioned is margins.
Yes.
That's going to be the name of the game in the down market, right?
Well, it's always the name of the game. You don't make margins, you're not going to be open. But margins are very tight. So what's really important, it's difficult to operate in a flat market because you have carriers trying to push their rates up and you have shippers trying to push their rates down, and they just keep squeezing because they're not really going either direction, and it's that margin that gets squeezed out if you're a broker. So I found it easier to work either in markets where at least the rate's moving up some, or at least it's moving, or down.
Gotcha.
Because a lot of times in this type of market, in order to create your margin, you're going to have to push those trucks down. So wise decisions on the loads that you choose, but sometimes you may not have decisions because there's nothing else to book.
Gotcha.
If a broker is not booking freight, they can't make any money. You have to have freight.
Right.
So there's a lot of difficulties right now. So you really have to get aggressive. You really have to get out there. You really have to be a go-getter, get on the phones, and step out of your comfort zone. Gotcha.
Wise words, ladies and gentlemen. So one of the things that the other aspect is Luke and I was talking about was times of growth. What's the shift when we have times of like we expect there going to be a lot of growth? How do we prep for that?
All right, so there are exciting times when you start shifting from where we are now to these times of growth that you're talking about. Now, you talk about it on probably more of an economic level, but we actually see these little cycles happen, and it's between like first quarter and second quarter in markets such as Lakeland, Florida. So they're going to be one of the first ones, Miami and Lakeland, that start switching over to produce season. And that's the difference of you calling out for freight versus you start seeing the driver start calling in, trying to pick up loads and trying to increase. And you just have a different feel of what's going on when you're making those phone calls. You'll realize if you're giving those prices and that shipper who's questioned you, talked to you, you've begged him for this price, you've pushed him up, all of a sudden starts accepting that price a whole lot faster. It's because rates are moving up and you might have just underpriced your freight. So you'll see stuff like that, and that's your first clue is when their response time to your rate is just really quick. And that's because they've called around and now you're cheaper than everybody where you were pushing the rates up. And so you'll see a change. You'll see a demeanor in the drivers. You'll see, and of course, the drivers will be getting a lot more excited. They'll be pushing their rates up. And then you'll see the struggle start hitting the shippers. And you got to pay attention of the demeanor of both the drivers, carriers, and your shippers that are on the phone. And then, of course, I had the ability to watch not only with the rates that I was booking trucks with, but also watch your colleagues where you can pull up similar lanes and start watching their rates as well. And you'll start seeing them start jumping up $50, $100. And that's how I figured out before Sonar that the market was starting to move. So now I can see it really within 24 hours. And when I start seeing it moving, I'm going to start pushing my shippers up. Now I have the ability to, instead of waiting on a rating tool to start a rating tool will be probably showing the carrier who's then repricing me, and that could be 10 days later. Now I have the ability to start pushing my rates up to my shipper 10 days earlier, which is being more proactive than reactive. And that's what's really going to help me out, in years like which we hope to see this start probably in July, August, really for fourth quarter. A really big upswing, or not a big upswing, but an upswing in this market that we're currently in.
And that's, so you hit a few really big points is being proactive, not reactive. Timing is everything, and really being able to pivot at the right time is going to be huge, especially for margins and really kind of that trial and error, minimizing some of that trial and error with that pricing.
And because that's where, you want to be able to maximize your revenues, and by maximizing your revenues, by one, getting the best price from your shippers, but you also want to get the most advantageous price from your carriers. So you can actually work on increasing margins on both ends. So if you get a little bit more from your shipper and you're able to control your carrier costs a little bit better, and that spreads can really increase when you're able to know the market conditions of not only the market that you're picking up in, but also the market condition that you're delivering to, because that's what the carrier is looking at, and that's the way they're pricing it. So if you can understand the information they're getting and what they want to do, that'll make you, that'll put you in the best spot.
Beautiful.
Love to hear it.
Yeah, I mean, I would summarize that, but you worded it perfectly.
It's a fast-paced job. And it is different every day. And it's exciting. I grew up in the spot market, did it for 15 years.
Yeah.
Most of my freight, probably around 80% of my freight picked up same day if I was lucky the next morning. So you really have to be on the spot when you're booking freight in that manner.
Gotcha.
Because we all say that we're great and we all made a lot of money here and there.
Yeah.
But we also all took a lot of losses. That's how we learn.
Right.
And I have some horrid memories. Yuma, Arizona to Denver, Colorado. And I booked 2 of those. And I lost big money on both.
Care to share a number?
Huh? Ooh, okay. Well, a rating tool.
You can give us a range.
A rating tool said $2,800. I booked it for almost $39. So I was doing. I'm looking at $1,000 margin. I was like,
oh, that's what you charge the shipper.
Yeah. So pick up same day. Capacity had swapped over in Yuma. Now it was 3:00 here on the East Coast, but they're a few hours behind.
Yeah.
I booked them for $44.50 and $46.50.
Oh, that hurts.
Yeah.
Thought you were gonna have a nice payday. Went the other way.
But that's the way it is.
That's the way it is.
Some days you win. Some days the driver wins.
Oh.
And that day, now Yuma's a very secluded market, so you can't really pull capacity from anywhere. And I rolled the dice. I thought I was doing well. The markets had shifted. Of course, a rating tool is 7 to 10 days old, and I played the game. But I opted. I knew it was going to be tight. I knew it was going to be tough. And I really took a beating that day, and I have never priced it. I'm still trying to seek my revenge on that lane.
Excellent. Well, Donnie, Luke, thank you guys both so much. I appreciate the insights. I believe we're going to shift gears here soon, and I think we have Mr. B on tap.
He's lined up.
Mike Bodendistel, yes. So without further ado, ladies and gentlemen.
Thank you for having us.
Thank you, Anthony.
Thanks for showing up, guys. I appreciate it. And in the meantime, I have to give a huge shout out to our production team. Jonathan Smith's running the show right now. We have a lot of amazing people. Cody Mathis, Oh, Mr. B.
Good to see you.
Mike Bonnet, good to see you. Welcome to the Freightonomics podcast. You were in one of the first episodes.
I think so, yeah.
So, Mike, you are a man of... I work with remarkable people, folks. And so you are one of these remarkable people. You have a very interesting background, right? Can you share with us?
Sure. So I was an analyst at Stifel for many years. First working for John Larkin on a wide range of companies that haul freight in some manner. The railroads are one specialty of mine. Intermodal companies were another. Also followed some trucking logistics companies with him, and then more recently rolled out my own coverage of the equipment companies, the companies that manufacture trucks, rail cars, components that go into those things, that lease rail cars, that are involved with selling trucks. So it's actually touched a wide range of companies in transportation and logistics.
Perfect. And so rail, intermodal, and equipment, right?
Yep.
Those are really some of your market expertise, right? We're a group of market experts,
yep.
and so that kind of rolls up your market expertise. And so one of the things that we were chatting with Luke, Donnie was here, was talking about how to operate in a down economy, how to operate in a down freight economy. And so curious, some words of wisdom from Mr. B himself.
Well, I think it depends a little bit on which companies you're talking about, which sectors. I mean, the railroads have really just been through a year where they had to operate with a lot fewer volumes. I mean, rail traffic in 2019 was down about 5%, both for the carload traffic and the intermodal traffic, and they responded the way they typically do, by cutting costs. And in the last year, they were able to cut costs for the most part faster than the revenue came down from the lower volumes. So they had margin expansion, by and large, and most of the stocks performed well, and most of the stocks, outperformed the market. I mean, Kansas City Southern dramatically outperformed the market. So again, they're still kind of darlings of Wall Street. I mean, and some of that has been, some of the things they call precision railroading, balancing the networks, streamlining the number of terminals, consolidating dispatch centers, those type of things. But a lot of it, I think, was just doing, more with less, or in the case of last year with rail traffic being down, doing less with even less resources. So that's really how the way the railroads have responded to it. And I think some of the other companies that I follow are really trying to get out in front of changes in demand, like the equipment industry for one. I mean, this is a year where the equipment industry levels of production are going to be down, rather dramatically for trucking. The Class 8 trucks, there are some that are expecting them to be down 30%, some more than that, 35% or so. With trailers, just heard from Wabash today, they're expecting their volumes to be down 11, which is a lot better than the industry for trailers, which is going to be down more like 25%. Gotcha. So all of those companies are struggling with, okay, how many, what are the right resource levels that I need? What are the right sort of input levels that I need? We've seen, staff reductions from a lot of the manufacturers over the last several months. Companies like Cummins, which makes, engines, and then a number of the OEMs as well. So it's really, I think, trying to get having the right resources in place, which goes to a lot of the things that we do with forecasting freight demand and those things.
Got you. And so that's going to be the key, right? Mm-hmm. Having or allocating the correct amount of resources where they need to go. And so that's going to be the name of the game during a down economy on this segment. So curious, Mr. Bowdendistel. Yeah. I've been practicing on that.
You're getting it. One of these days you'll have it down.
I'm going to get it the first time. One more time. Bowdendistel.
That was perfect.
All right, I'm going to stop it right there.
Okay.
Mr. B from here on out. So I'm curious on your take on the rail side, your outlook.
Well, really, it comes a lot down to volume. So I think one of the interesting things is the rails have really demonstrated ability to, like I just said, use cost very efficiently for the amount of volume they have. Yeah. I think the main question and the reason why the stocks are trading at multiples that are really above levels than we've seen in the past is this thought that if rail traffic comes back, what's going to happen to margins then? Because they've been improving margins with down volumes dramatically. And, you have to think, I mean, it's a network business still. There's a lot of, fixed costs involved in that network. And some of the volumes that come back can go back on a train at a very low incremental cost. If you have a train that has 80 rail cars and now you have more traffic and now it's 100 rail cars, there's not a lot of extra costs involved in that. A little bit of fuel, but not much. A little bit of equipment rent, but the crewing costs are the same. I mean, most of the costs are fixed. So a lot of that should come in at a very high incremental margin. And I mean, it's could see greater records on the rail industry. So I think that's why the stock valuations are where they are. I think there's a lot of optimism there. And some of the rails are saying, well, we're past the worst in terms of volume, and going forward, volume should be up. Now, some are saying it should be up if you exclude coal, which is going to be a huge drag, particularly for the eastern rails this year. But still, it feels a lot better to maybe get into some months where the volumes are positive on year-over-year basis, whereas last year it was all sort of red ink and sort of got worse, as the year went along. Yeah.
And so, excellent take. But so, are you expecting something different or similar on the intermodal side?
Intermodal is more going to be dependent on what happens in the trucking industry. Yeah. So there's this growing sense of optimism that the trucking industry is going to be strong in the second half of this year because of capacity coming out of the marketplace. Yeah. Maybe that comes to fruition, maybe it doesn't. So some of the intermodal companies are saying, well, this is going to be a sort of a year of two halves, where in the first half of the year, it's going to be a little bit of a struggle because there's not going to be enough volume, and they're going to have to negotiate intermodal contracts that are lower than they were in the previous year, which just doesn't feel good. Meanwhile, they're still contending with, rail purchase transportation costs that are still rising, so their margins get squeezed. So a lot of the companies like a Hub Group or JB Hunt, I think, are in a little bit of a difficult situation in the beginning part of this year. It's a question of, if this trucking capacity crunch and the pricing really does come to fruition, it's going to feel really good to be in the intermodal industry later this year. Yeah. Because their price, they'll get pricing. The volume will be there as well. It'll be sort of an outlet for some volume that maybe there's a shortage of trucking capacity for, particularly in the longer haul lanes. So and that could lead to stronger contract pricing next year at this time. So I think there's that one is maybe a little bit more uncertainty because who knows if that's at this point if it's really going to come to fruition. Sometimes if everyone expects the trucking industry to tighten, maybe that leaves some of the capacity hang on for a little bit longer because they're expecting it too and they want a piece of that action.
Right. And so that uncertainty, does that also extend into the equipment side of things?
I think it does. I think on the equipment side of things, I mean, the equipment tends to follow what is happening in the trucking industry, particularly spot rates. I think there's little question that equipment production will be down in 2020. And a lot of that's just after record or close to record levels in 2018, 2019, and then there were also strong production in 14 and 15. So really, 4 of the last 6 years have been very strong from an equipment standpoint. So there's enough equipment, and with the equipment, the main question I think is when you think to later this year, when we get into October, November, is there going to be a surge in orders or is there not going to be? I mean, I think you can make the case a little bit, either way, and I think a lot of that is going to depend on whether or not we see the trucking market start to improve. But either way, for the equipment companies this year, 2020 is going to feel like a little bit of a slog, because it's just not fun when your revenue is down 30% or something like that. Yeah.
Right. And so one of the things that you just did throughout your synopsis, brilliant synopsis, by the way. Thank you, Mr. B. It's I always feel enlightened when I hear your takes. You gave us an awesome breakdown of actual results. And so previously we just had, Luke and Donnie talking about their past experiences and some anecdotal stories. And so you're giving us some of the real world. And so I think Seth Holm is out here ready to go with us. Seth, is Seth here? Seth, you going to join us?
I don't see him.
So Seth Holm, I think, is here.
There he is.
And he's going to join us. And oh my goodness, this is a lot of intelligence that I'm sitting next to here. Seth, another brilliant man here at FreightWaves.
So we have a former buy-sider and a former sell-sider.
Yeah,
in the same room.
So Seth, I don't know if you need an introduction because your name is all over the place, right? You're really popular with the white papers. You really head up a lot of our research stuff. You have an excellent background. Also a former hedge trader.
Yeah, that's right. So like Mike said, I was on the buy side. So I worked at a hedge fund for about 10 years. I'm really a stock guy. Funny enough, I did consumer and telecom, media, and internet and technology stocks. So I knew a lot about that space. Got to FreightWaves a little under a year ago now. So now I'm doing transportation. And I am part of the Freight Intel group with Kevin Hill and Andrew Cox. That is actually now part of Passport Research, which, we have a new offering for, and we're putting out stuff all the time. And so, recently I put out 3 or 4 papers. I did one on the XPO spinoff, which I know we're going to talk about. I did one on detention time and trucking. I just did one on that'll be coming out this week on freight brokers and how they performed in the current fourth quarter earnings and all that kind of stuff.
So really looking at transportation, you mentioned transportation overall, not just one particular component, but really analyzing, doing that deep dive and giving us actionable or really insights that you can't really find anywhere else.
That's right. I mean, I do all things, but, like Mike knows so much more than I'll ever know about intermodal. My strong suit, like a lot of people at FreightWaves, is probably trucking. But we do lots of other stuff as well.
Right. And so one of the things we're talking about, actual real world instances of companies performing in a down market. And so one of the companies you just mentioned, XPO.
Yep. So I kind of jotted down some notes. So you asked me, how can you perform better in a down market? And I thought of a few ways from listening and reading earnings notes and listening to the calls a little bit. There's a couple of common themes. In truckload, I think you can have more contract revenue as a percentage of your base. I was just looking in the fourth quarter on a year-over-year basis, contract rates were down about 3.7%, whereas spot rates were down like 13%. So if you're playing the spot market, if you have greater exposure to that, you're going to have greater revenue declines. The other thing you can do, another common theme that I saw from a lot of the truckload guys is the more dedicated exposure, the better. So dedicated, that's been a very common theme. Dedicated is generally up year on year, as opposed to pretty badly down for the other segments. Although I did read a piece from Todd Maiden that he put out from the Stifel conference yesterday where the Werner CEO commented that because Dedicated's been so good, that there's a lot of people rushing in and putting pressure on those bid prices. So that's another way. And then the two other ways I sort of came up with are, let's see if I can remember them. So Zach Strickland wrote the chart of the week.
Yeah.
So the wholesale rack prices have been coming down aggressively, like 40 cents in the last week, whereas those retail gas prices are sticky high. And so those net fuel surcharges are going up. So like wholesale rack prices, I think we're down 13%, whereas the retail prices were steady. So that's 20% of a carrier's revenue that they spend on fuel. So that's another way. The other way you can do is you can reduce headcount, right?
Yeah.
So those are the really obvious ways to me. And now if you want to get into XPO a little bit, I can talk about some takeaways there as well.
One thing that just comes to mind, you bring up Werner, for them specifically, they have a lot of customers that I would call defensive in nature. They do a lot with the dollar stores, Dollar General, Family Dollar, and I think those companies, do well when the economy slows.
Yeah, I think the CEO commented again. He said like 55% of their revenue comes from directly from the U.S. consumer.
Yeah.
So like you mentioned, that's a really good spot to be, certainly relative to someone who has their freight volumes tied to manufacturing or anything like that.
Right.
Yeah. So you want to get into XPO a little bit?
Yeah, let's get into XPO.
Okay, so XPO is kind of, we put out, if you're a Passport Research, about a month or two ago, I put out a report kind of with JP and Kevin and others analyzing, so they made a big announcement. They had long been this roll-up. They'd made like 17 acquisitions since they went public in 2011. They've got Brad Jacobs as their CEO. He owns a big chunk of the stock, and it's been this very successful roll-up story.
Yeah.
And now they made an announcement that they're going to basically everything other than LTL, and they're sort of a transportation conglomerate now, is technically up for sale. And so a couple things there. Just in the most recent quarter, first things first, they got a new CFO.
Gotcha.
And this guy came from, I've already forgotten his name. I listened to the call yesterday. I think it's Weichner is his last name. But he came from Wyndham Hotels and Resorts, and prior to that, Avis. And so this guy's like a asset sale and spinoff specialist. So that kind of shows you, that they're making moves to go ahead and do this. The other thing, the main takeaways I saw from XPO in the quarter, looking at LTL, it becomes sort of apparent why they want that to be the remaining business. LTL performed really well for them. I want to say, so it was the former Conway, is that right?
Yep.
I think revenues were, I don't remember exactly what they were off the top of my head, but really strong relative to the rest of the business and relative to the other LTL players. And the other thing was their OR in LTL was down like 500 basis points year over year to like 83 some odd percent. Now, some of that was an asset sale in there, but even then, they improved their OR by 150 basis points year over year in a really sort of tough market for trucking. And the other main takeaway I had was so Brokerage. So I did this whole piece. Like I said, I did a deep dive looking at everybody's results in Brokerage, and they grew their truckload volumes in Brokerage by 1%, which was really good relative to the other publicly traded guys. And it would have been 19% had it not been for that Amazon customer loss.
Gotcha.
And the other really impressive thing they did was they grew truckload brokerage volumes 1% on a 20% reduction in headcount. So to me, that was pretty impressive. So
is that becoming more automated? Is that how they're doing that? Or just kept their better people?
I think so. I think they've made heavy investments in technology, and I think some of that's beginning to bear fruit. But then, they also grew their earnings per share like 55% because they bought back in 25% of the stock over the past year.
And so I'm curious so one of the things you mentioned, their OR. Yeah. That was really one of the big changes or things that really kind of stuck out from them and some of the other companies, correct?
Yeah, exactly.
So I think that's going to be a huge component, I think, definitely as we move through the first half of 2020. Do you think that's also going to be like a huge impact on the second half of the year? So my overall outlook is like, so just looking at truckload,
right now you've got positive volumes. They were up 4.5% OTV. Outbound tender volumes were up 4.5%.
Yeah.
They've been basically sustainably positive since last July. So the volume picture, although it's off to a weak start on very easy comparisons this year, it's like flattish for the last couple weeks. But that being said, I would expect volumes to be flat to modestly positive this year, where the brunt of the revenue declines for the truckload guys has been coming through rates, both spot and contract rates. I think the outlook, and a lot of that is because of the excess capacity in the market, which, with the 5% tender rejections, really low. So I think as the year goes on, and this isn't a unique opinion from me, a lot of the trucking executives and other people within FreightWaves, I think, share this view, that the outlook for both spot and contract rates is sort of sequentially as you progress throughout the year should improve, driven by, as you kind of work down that excess capacity. You've got, the ELD stuff, you've got the drug and alcohol testing, you've got the bad truck orders and all that kind of stuff. So as far as the ORs, I think what you can read into the OR, I think if you're an investor in these companies, you can sort of take comfort in the fact, like, a lower OR gets you a higher multiple. All right? Because your earnings don't go down as bad in a bad market. So I think Old Dominion, who's like the blue chip in LTL, if you take apart XPO on a sum of the part basis, and I won't get to, this is too complicated, but Old Dominion trades at like 15 times forward EBITDA, whereas the implied value for XPO's LTL is more like 8, 9, 10 times, something like that. So I think there's a lot of headroom, for expansion in that multiple. And anytime you look like Knight Swift, the old Knight had a really, really low OR, and that always got them a premium multiple. But when I sort of take apart the cost picture, diesel looks pretty good. You've still got some wage inflation there. But I think the natural lift to ORs is just going to come from better volumes and better revenue, honestly.
Gotcha.
Yeah.
Seth, amazing.
Yeah.
I'm honored that you showed up here to this podcast, Freightonomics, at the same time with Mr. B. So thank you both so much for showing up. I think we're going to have Andrew Cox, someone that you work very closely with there.
Great.
He's going to hop on in, but thank you both so much for joining us. We're going to see if we can get Andrew Cox in here, and I think he's going to give us a little bit more insights.
Of course.
Great.
Excellent.
Thanks, Anthony.
Thanks. And guys, I'm going to have to give you more shout outs because our production team runs deep. We also have Emla Howard, the intern, one of the most talented people I've met next to Cody Harris. But now we have Andrew Cox here.
What's up, brother?
How you doing?
I'm lovely. I've got this very nervous energy, and I don't know. It's not for this or anything else.
Just in general.
I'm anxious right now. I'm feeling good.
Well, I'm excited you're here.
I'm excited to be here.
So as I mentioned earlier, I work with some very remarkable people. Andrew, you are definitely one of them. Because
don't feed my ego.
I'm just saying you're a recent grad, right? You're new to the industry, but you absorbed it so quickly and really become one of the cogs here, one of the key engines to really power a lot of the research.
Well, I really appreciate that. I think I saw you mention it earlier about so many remarkable people around here. The FreightWaves, everybody is so smart around here, and there's so much industry knowledge and so many different ways that you can learn around here. So I've just tried to be a sponge. From Dean all the way down to all the market experts, there are a lot of smart people here. So I've just listened and absorbed.
Dean is he knows everything about everything.
Yeah, you ask that guy any question, and he's got at least a 10-minute response to you. Very in depth, built exactly how a response should be. He's brilliant.
And it's sometimes I think I'll catch him on a curveball. I'm like, no way he's gonna know anything. It's an obvious joke, and then he'll come up with an actual legit answer.
He knows it. He knows everything.
And so, Andrew, one of the big things that I seeking your insights on, because usually I have Zach Strickland here. As I mentioned, he's going to be back. Don't worry, he'll be here next week, everyone. All right, he'll be here. He's skiing in Colorado.
Oh, lucky man.
I know, and so he'll be back. But one of the things that Zach does for me is he brings me back down because I get so optimistic sometimes. I talk about consumer optimism. I talk about, all the bright spots in the economy. Oh, non-defense capital goods starting to rise up. Business activity starting to kind of peek its head a little bit. And he kind of reels it all in. And so one of my questions, Andrew, is what are some of the headwinds that we have in the upcoming year.
Let me forewarn that I try to be a realist, but I'm also an optimist.
Yeah.
So I'm going to do my best to play devil's advocate.
Please.
Here, and we'll play back and forth.
Yes.
But this may sound cookie cutter, but I truly think there are really only two major headwinds, and that is trade disputes, even though we've had a little bit of headway in those in the recent months. And then global economic slowdown in general.
Yeah.
We can start with whichever one you want. We can start with trade.
Yeah.
There's been the two trade deals that have gotten done in the last month or two. The USMCA, which is, in my opinion, and a lot of people's opinion, just a glorified maybe cover change, putting a hard back on the on NAFTA, and rather than having it in a soft back. Not much change there. And then you also have the Phase 1 trade deal, which was a big step. We kind of posed it on our podcast the other day on Great Quarter Guys whether we ever thought there'd be anything past this. Would there ever be a Phase 2, Phase 1B? And we came to the conclusion that there probably won't be. And then on top of that, the trade deal itself hasn't, although it just happened, we'll see what the ramifications are this year. But leading up to it and since then, we haven't seen the purchases like we were expecting to see from China. We haven't seen the exports going to China in the same manner. 2019 was a horrible year. I got a couple stats for you here. Was a horrible year for, I can remember, exports and imports both fell in 2019 from 2018, and then they fell from 2018 from 2017. So it's down 2 years in a row. I have a big worry about this trade deal when they say that China's going to buy I think it was $40 billion worth of ag on a yearly basis.
Yeah,
that's double anything they've ever done. And I know China's population is huge, but it's slowing. Their growth is slowing. So I just don't know how we get to $40 billion in ag purchases. And in my mind, I think the relationship has just structurally changed between us and China in the last decade, or even 2 decades. And I think now, at this point, we have a more difficult time replacing China than China does replacing us.
Got you. And so one of the big parts of this trade deal, right, is those agreed upon purchases, especially for ag. But there are also some contingencies, right? So things need to be met on their end. They need to see certain economic growth internally or domestically for them before they could commit to some of these purchases.
Correct.
And so it's not guaranteed. It's almost like the Phase 1 deal was an act of good faith.
Yeah,
so to speak.
It's almost like contract rates in trucking. We on this date we set you this rate, this many trucks. It's like but we got to that day before, and the environment has changed. So we're no longer going to uphold that thing. So I see a similarity there, and I agree with you. And we've talked about this on shipper updates, that there's just an ill-timed coronavirus at a time where Chinese growth is already slowing to 30-year lows last year. It's going to probably creep even slower this year, under 6%. So they may not even meet those internal thresholds they need to fulfill the ag purchases from the U.S. The reason I say that I think we're more expendable to them than they are to us, on the Chinese side, when they needed to find a soybean provider, they were easily able to find one in Brazil and Canada and even the EU. And the EU, again, with pork, they produce more pork than we do. So they were able to find suppliers for their ag, where we went over our manufacturers were trying to find replacements for Chinese production, and it's just nobody else is anywhere near their level. Yeah,
and I think one of the areas we tried to target was Southeast Asia, right?
Right, like Vietnam, Cambodia, Laos.
Just the sheer size, right, and trying to replace a mammoth like China, that's going to be difficult to do. And so, as you mentioned, that kind of really resonates with it's going to be hard to kind of try to replace them.
Definitely. Lorianne LaRocco yesterday was on our podcast, and she said that she again spoke about Vietnam as a replacement. People thought that they could be a viable replacement for China. You would need 7 or 10 Vietnams to replace Chinese production, imports to the U.S. So, and beyond that, their facilities and their people, their labor is just nowhere near at China's level. So that's one thing. I think that the trade disputes they're going to be long-standing. Even if we do get things sorted out with China, let's say there's a Phase 2 or even forward, I think we're more expendable to them than they are to us.
Yeah, and one of the areas so there's 2 economic regions that I'm really interested in. India, just from a general economic growth, but Mexico, because they're so close, more affordable labor and so close to the United States, and so being able to near source, I think, would be a potential opportunity there. And so I'm really interested in seeing how Mexico really kind of comes to its own over these next couple of months or years, so to speak, if things kind of keep going the way they are with China.
Mexico is just a mystery to me. They have everything they need to be a developing powerhouse, above the, not quite a tier 1 economy, but right there at the top of the tier 2 economies. And it just baffles me how they can't get either their government and their monetary policy in order to be able to exponentially grow their economy. They have, they've got a strong working labor force. Good population growth. Healthy people. There's absolutely no reason that they couldn't, and a lot of natural resources to grow with.
Exactly.
Doesn't make any sense.
Yeah, so that's going to be two nations I'm going to be watching closely over the next few years. It's going to be India, Mexico. Like you said, it baffles me as well why we're not seeing that kind of growth on Mexico. But one of the headwinds that we're talking about on the Chinese side, coronavirus. And so in my slow start, strong finish economic outlook, available on FreightWaves.com, on that one, nice plug, a little plug. One of the things I mentioned there was a black swan event. And so this has without a doubt been a black swan event.
Yeah, and it's just so ill-timed. Like you've got good timing on the fact of when it first happened. For the factories were already typically shut down during the Lunar New Year time, but that is a time when all the Chinese go out. They travel to see their families. They eat out. They buy luxury goods. They spend so much money on airlines and hotels, and it's a big time for Chinese tourism and economy. So now that that's been really strangled for the last few weeks, and it will continue to be strangled. This is I think we're going to see Chinese GDP in the very low, as low as like 2-3% for the first quarter.
Yeah, if they report it.
Yeah,
but
11% growth.
Exactly.
You're fudging.
We'll see. We'll see. And so, real quick summary. One of the things is these headwinds are really going to kind of impede growth potentially on the manufacturing front. That phase 1 deal, we're really hoping to see something happening with agriculture because the farmers had a horrific year.
Correct.
In 2019.
I've read some crazy stats about the amount of money that they've had to earn in subsidies versus what they've earned, selling crops. It's scary. Yeah,
and so a few of the headwinds to really monitor coming up here and 2020, and I don't know if you have a few moments here.
I can hang around.
Yeah. Well, I think we're going to have Marianne joining us here shortly.
Cool.
So
I see her there. See if I can
is she coming on in?
There she is.
Is Marianne around?
Yeah.
Oh my goodness. Marianne.
I love this tune, by the way.
It's amazing, right?
Today. This is nice.
Hey,
Marianne.
how's it going?
We're great. How are you?
I'm doing all right.
Thanks for joining us.
Thanks for having me.
Oh my goodness. Okay.
Let's see what I can do here.
So, Marianne.
Yeah.
You kind of keep Zach and I in line.
It's a really hard job. I'm not gonna lie.
Zach and I in line.
It's not easy, but I do what I can.
Yeah, and I'm very appreciative of it. I'm very appreciative of it. For those of you that are familiar with our monthly Sonar webinars with Zach Strickland and myself, Marianne, you're always there with us. Usually the introductory voice and the closing voice, and you set that all up.
Yeah.
And you run essentially, I'll let you tell us.
Yeah, so I essentially head our media operations here at FreightWaves. Anything that we partner with companies to do, so sponsored media, whether it's webinars, editorial, infographics, podcasts. I basically oversee execution and fulfillment of all of those things. So
right. Yeah. And so with that, one of the things that we've been talking about throughout the entire podcast is we had Luke Donnie in here talking about how to grow in a slowing economy or freight economy on the broker side. We had Mike Bowden-Distel, Mr. B, himself, giving his insights on the rail, intermodal, and equipment side of things, on how to operate on downsides, things to kind of keep your eye on. We even had Seth Holm make an appearance, giving us real-world examples. We have Andrew Cox telling us about potential headwinds. And so I'm really curious. So you head up operations as well. You've seen downtimes. I'm curious, what kind of campaigning should someone consider, or really, what should be the thought process during the downtime?
Yeah, absolutely. So typically what happens when funds are low, people are just concerned about sales.
Yeah.
However, counterintuitively, I guess, marketing is usually the first thing to go. It's very counterintuitive because marketing is its sole purpose is to drive sales.
Yeah.
So when times are tight, really the best thing that people can do, it's a lot more expensive in terms of both money and resources to go out and find new business. So the number one thing to focus on is loyalty and retention of your current customers.
Gotcha.
Upselling is great, but during tight times, you want to definitely make sure that the people that are partnering with you want to keep partnering with you. The second thing I would say is outsourcing. If you don't have a full marketing department in-house, or even if you have one or two, typically it's a lot easier to outsource that work to an agency, to a creative agency that can fulfill those things for you. Separately from that is really focus on your digital efforts. If you do have a team in-house, online, everybody's online. It's really easy to reach your audience there.
Yeah.
So those are some big key pieces to focus on. And then really, more than anything, just make sure that you're spending your efforts on the things that you know are proven to deliver ROI for your organization.
Gotcha.
It's not the time to test when money's tight.
So ROI, that's huge. And you mentioned digital marketing as well.
Sure.
So I'm guessing that's a huge factor into ROI potentially on that digital side.
Yeah, absolutely. It's measurable.
Yeah.
Right.
Yeah.
So anything that's print, anything that's out on a billboard, there are ways that you can get a good sense of how well they're performing. But if you want true measurement to be able to justify investments, digital's the way to go.
Yeah. And so I'm guessing ROI is really also going to be the mindset, right?
Absolutely.
Throughout the downtime.
It's all about your data.
Yeah.
And we're all about data here at FreightWaves, so it makes a lot of sense. Your data and your ROI, what are they telling you about what your efforts are doing? That's where your mindset needs to be. Focus on the things that you know are driving value for your organization. Yeah.
And so, Andrew, enough of this down talk, right? Enough of all
Let's
this.
get back to the optimism here.
Let's get back to the optimisms. All right, so Marianne, here's the scenario.
Okay.
I'm seeing the market turn, right?
Okay. Yep.
What is my shift in times of upturn on a kind of campaign mindset?
Are you asking what to focus on? Or
Yes.
Well, when times are good, that's the time that you can kind of, it's important, first of all, to plan ahead.
Yeah.
If you have data available that kind of gives you an idea of where the market's heading, read that data. You can kind of see trends that point toward an upward slope, hopefully.
Yeah.
That's kind of that will help you to know how to plan out your investments. If you have something that is a little more money or resource intensive, you can start to integrate those things as things start to trend upward. But yeah, like I was saying, while things are down, focus on the less.
Yeah, maybe.
No, I was just gonna say, the old stock market saying, it's like be greedy when others are weak, or when others are not. Do you think that holds for like a marketing aspect when you can kind of feel something coming on the upside? Maybe it's 6 months or a year out. Do you think that's a time at which you try to ramp up things while others are still behind the ball? Is that a good time to try to gain some market share?
Yeah. If you have the information that's pointing to that, I would say absolutely. If nothing else, it's going to give you more of a competitive advantage to be able to kind of read those trends and what's happening. Yeah,
and I think that's really been a huge point from everyone that I've heard so far, is really kind of trying to expand that market share and really kind of capture more of the market.
Yeah.
And as you mentioned, that you really honed in on also focusing on your existing clients, your existing partnerships. And so I think that's words of wisdom.
Oh, agreed.
Well, thanks.
To take throughout life.
Yeah. So, Marianne, the other thing is, we've seen you. Andrew, you're probably not ready for this, but
he's not.
Okay. I've seen you both in the comments and also in person. I've let you down a lot.
Yeah.
So, Andrew, usually at the end of these with Zach Strickland and myself, I have a hot take. It didn't start out as a hot take. It was just going to be a thing that Zach and I disagreed on.
Okay.
But it turned into me having a hot take and it being unpopular opinion.
Okay.
And I am batting 0% with Marianne taking my side on any of those things.
Anthony, you like to be kind of a contrarian. That's the thing. You
a new perspective.
I don't know that I would
Thank
call
you.
it that. I don't know that I would call it new perspective.
Yeah.
I think it's. I
Just
don't know.
a blurry one looking in the opposite direction.
Exactly.
Yeah.
Just like, you know what? This view isn't all that bad. It's just a little blurry, but But I digress.
Yeah. All right.
The thing, Andrew.
Give us the hot take.
Marianne.
No,
And I don't even think this is a hot take, really.
All right.
it's not.
California is overrated.
No.
California is overrated.
I'm giving you an outsider's perspective. I've
Yeah.
never been west of Colorado, so
Okay.
whatever I say after you guys give your opinions, take it with a grain of salt.
Please.
Before he even gets started, I'm just going to apologize on behalf of FreightWaves to anyone from California who may be listening. I spent a great deal of time there myself. Go ahead.
Yeah,
Give
well,
us. Is that it? Substantiate this. I need you to give me
I
something.
think California is a great place to visit, right? You go there, you do maybe a week or two, you go Southern California, San Diego, Central, you go to LA, the Bay Area, you see the sights, you have a good time, and you get out.
Yeah, why do you get out, though?
Well, you get out because you need to make at least $450,000 a year in order to just have a studio apartment, and then you're paying $18 per gallon at the pump to fuel up your Prius. But then you got to get some breakfast, right? So you pull up to the nearest
The taco shop.
or
Yeah.
The breakfast
the
tacos.
tacos.
I've
burritos are good.
heard the breakfast tacos in California.
They're
are
good.
San Diego's
They
just unreal.
Are
They're good.
out of control.
But you're more likely to, not more likely, but also likely to come across a nice little shop, a one-offer, and drop a good $34 on some avocado toast.
That's not true. Come on. It's not so bad. No, here's the thing about California. There really is something for everyone. Do you like strawberries?
I do.
You do?
I do as well.
I do.
Tons of strawberries grown in California, Watsonville actually, and other places, but that's a big one. Do you like garlic?
No.
Yes.
like
The
garlic.
thing you
You gotta
eat
like
pizza, you like garlic. Gilroy, California is the garlic capital of the world. Do you guys know that?
I've heard Dean say that before. Yeah.
Yeah.
Of course you heard.
I think every little town in America is the capital of something.
Yeah.
He knows them all.
Yeah.
Here's the thing.
Uh-huh.
You really can have the best of both worlds in California. I could literally wake up and go to the beach and say, I don't really want to be at the beach.
Yeah.
I'd rather go skiing. And I can drive to Tahoe and I can do it all on the same day. What can you...
That's a hard argument.
What are other places that you can say that about?
Arizona's pretty versatile. Because you can ski
They're skiing
in Arizona.
I don't know about
You can
that.
ski in Arizona.
I don't know about that.
And then
Sand skiing?
there's like you go up north in Arizona, there's mountains, there's snow, there's Sedona, Flagstaff, you have a good old time, snowboard, all that stuff. Come on down, you can find greenery in Arizona, hard to believe. But then you also have the desert landscape and get right back to the 70s, 80s at a fraction of the price.
And do you like wine?
I don't drink alcohol, no.
Oh, well.
Surprise.
Yeah.
Surprise.
It's wine country. I mean, and it's not just one. You've got Sonoma and Napa and Healdsburg and all of that, but then you've got more like the Central Coast. You got the Paso Robles. Oh, man.
Just
and
making a
even
good
down by
argument
San
here.
Diego. Temecula.
Sounds basic.
Yeah. It's not basic. It's delicious.
I don't know.
I could see you being a little bit of a wine connoisseur, man. You need to, you need to dip your toe in every once in
All
a while.
right, so maybe
And
I'll expand.
Disneyland.
Okay, Disneyland. I've had good
Here we
visits
go.
to Disney-
All right, we're ending on a high note.
Back to visiting. I can visit. Okay, so I think the middle ground is I can visit, but maybe I can't live. It's a good place.
That's kind of how I am with New York.
Yeah.
I absolutely love New York. I would live in New York, but I wouldn't want to work in New York. I think there's a big difference there. Working 80 hours a week,
Yeah.
getting your teeth kicked in by the New
Yeah.
York speed. I wouldn't like that. I feel like California would be a similar thing.
I've done
the
both, and I
regulations.
loved both for very different reasons. But yeah, I mean, at the end of the day, taxes,
Yeah.
cost of living,
Yes.
it's hard to overcome. So
is.
to your point, for those wanting a certain quality of life,
Right.
maybe visiting's the way to go. But
Oh,
I
and
would
the
not
traffic.
say. But I would not say it's overrated.
The traffic,
oh yeah.
the infrastructure. Oh my goodness. I've seen horrific pictures.
Yeah, I mean the traffic's so bad. Elon Musk decided he's going to start building tunnels under.
Exactly.
he was sick of it.
All right, so I think this is the better arguments than Zach.
Well,
You know,
I think you and Zach agree. You guys agree on a lot of things.
we do, unfortunately, but not on food.
Not on food.
Not on food.
You're not allowed to talk about
No, I can't talk about food anymore, and I'm okay with that. But Marianne, thank you so much. Andrew Cox, thank you so
guys.
much.
Thank you, sir.
And thank you all for coming and viewing this episode of Freightonomics. We're always streaming, and we're out. That was fun, guys. So I'm playing us out.
Yeah, I really.
We're still-
I like your hip hop.
Can they
Yeah,
spin?
I mean, they can.
Yeah. Oh, yeah.
Can they hear us?
Oh, yeah, they can hear
Oh,
us.
watch what you say.
Oh, yeah.
This has been fun.
Zach appreciates what we've done.
He is definitely not.